Every law firm I've worked with believes their billing system works just fine until the numbers don't add up. It's a common story. You're busy managing cases, dealing with clients, and running a business. The last thing you want is a financial puzzle. But when you look at your P&L statement, something feels off. The revenue you see doesn't quite match the effort you're putting in. It's not always fraud or even bad bookkeeping in the traditional sense. Sometimes it's just one missing piece in your billing workflow that quietly leaks revenue every single month, often without anyone noticing until it becomes a significant problem. Let's talk about the real problem, the one that hides in plain sight. You're using fantastic legal case management software. Maybe you're on MyCase, Clio, Smokeball, or Practice Epenther. These tools are powerful. You record your time meticulously, you apply retainers, you generate and send out professional-looking bills. From the front end, everything looks smooth as silk. Your clients get their invoices, they pay them, and your case management system shows that the account is settled. Perfect, right? But here's where the disconnect happens. Behind the scenes, in the digital handshake between your legal software and your accounting software like QuickBooks or Xero, something small often goes wrong. It's a subtle, insidious issue. Those invoices you so carefully created might not fully sync over to your accounting system. We see it all the time. Sometimes the client name or the specific matter name gets dropped during the transfer. So, you have an invoice in QuickBooks, but it's not tied to anyone. Or, even more confusingly, the payment syncs perfectly, but the invoice it's supposed to pay never makes the journey. And that's when things start to slip through the cracks. You glance at MyCase and it tells you, Client John Doe has paid invoice 1 to 3. You feel good. You move on to the next task. But then, you or your bookkeeper opens QuickBooks, and it's still showing an outstanding balance for invoice 123. Now you have conflicting information. Which system do you trust? This isn't just a minor administrative headache. It's the beginning of a data integrity breakdown that can have serious financial consequences for your firm. You're now operating with 2 different sets of books, and that's a dangerous place to be. This leads us directly to the hidden revenue leak. When your billing and bookkeeping systems aren't perfectly aligned, revenue doesn't just leak, it hemorrhages silently. These discrepancies create a cascade of problems. For instance, you might have a growing list of unapplied payments sitting idle in your accounting software. This is money your firm has received, but because the corresponding invoice is missing or mismatched, the funds are just sitting in limbo, not properly credited as income. It's your money, but your financial statements don't reflect it as earned revenue. Another common issue is double-counted income. This can happen if a payment is recorded manually in QuickBooks and then also synced automatically from your billing software. Suddenly, your income looks inflated. While that might feel good for a moment, it gives you a completely false picture of your firm's profitability and can lead to you paying more in taxes than you actually owe. And then there's the big one for law firms: trust accounting. Retainers are a critical part of your cash flow. A client pays a retainer, you record it in your case management software, and as you work, you draw funds from that retainer to pay your invoices. But what if those draws are never reflected correctly in QuickBooks? Your trust ledgers in your case management system might look perfect, but your bank balance and your accounting records tell a different, conflicting story. The trust balances in QuickBooks look off. This isn't just a financial reporting issue. It's a compliance nightmare waiting to happen. An inaccurate trust ledger can put your firm at serious risk during a bar audit. The problem isn't just about wrong numbers on a screen, it's what those wrong numbers cause. Your key financial reports, the very tools you rely on to make strategic decisions, lose their accuracy. And suddenly, you're making critical choices about hiring, spending, and growth based on incomplete or incorrect data. Let's picture a clear before and after scenario. The before is probably familiar to many of you. It's the end of the month, and you or your office manager is staring at a messy spreadsheet. You're manually exporting invoices as CSV files, trying to reformat them to import into QuickBooks. You're retyping entries, line by line, hoping you don't make a typo. You're hunting down mismatched dates, trying to figure out why a payment from last Tuesday is dated for yesterday. You're adjusting payments, splitting them between different invoices, and spending hours, sometimes your entire weekend, on this reconciliation marathon. It's frustrating, it's inefficient, and it's prone to human error. You are essentially paying for your time, or your staff's time, to do work that technology should be handling for you. Now, let's imagine the after. In this picture, your systems are seamlessly integrated. You create an invoice in Clio or Smokeball. Instantly and automatically, that exact invoice appears in QuickBooks with the correct client name, the correct matter, and coded to the correct income category. When the client pays, that payment is also automatically synced and applied to the correct open invoice. There are no manual entries. There are no weekend spreadsheet marathons. There's no second guessing the data. You just have accurate, real-time reports that you can actually trust. You can pull up your P&L, your balance sheet, or your trust liability report with confidence, knowing that the information is a true reflection of your firm's financial health. The time you save isn't just a bonus. It's time you can reinvest into practicing law, serving your clients, or growing your firm. So, what is this magic solution? What is the missing piece? You might be thinking you need to buy more expensive software or completely overhaul your tech stack, but that's rarely the answer. The missing piece isn't more software, it's connection. It's about ensuring your existing systems, the ones you already know and use, actually talk to each other correctly and consistently. When your billing and accounting systems are in constant, automated communication, the entire workflow becomes seamless. It's like having two key team members who finally start speaking the same language. When this connection is properly established and maintained, everything falls into place. Revenue recognition becomes accurate and timely because payments are applied correctly the moment they're recorded. Your trust ledgers stay in perfect sync across both platforms, dramatically reducing your compliance risk. And most importantly, your financial reports finally tell the same, single story that your billing system does. There's no more discrepancy, no more confusion, no more doubt. You gain what every law firm owner needs: a single source of financial truth. This integration is the foundation upon which sound financial management is built. It's not a luxury. It's a necessity for any modern law firm that wants to be both profitable and compliant. So, what should you do now? This isn't about selling you a service. It's about empowering you with awareness. Most firms don't need to throw out their billing software and start from scratch. They just need the connection between their billing and bookkeeping to work properly, every single time. Here's a simple action you can take. Take a moment this week to check the integrity of your workflow. Pick 5 recent invoices from your case management system. Now, trace their journey. Did the invoice itself sync to your accounting software? Did the client and matter details come with it? When the payment was recorded, did it sync and automatically apply to that specific invoice? And if it was a trust transaction, did the retainer deposit and the subsequent invoice payment from trust get recorded correctly on both sides? If you find that even one part of that chain is broken, if there's any manual correction, any missing data, any discrepancy, then your revenue reports are likely flawed. Start there. Investigate that small break in the process, because that's usually where the missing piece of your financial puzzle hides. And finding it is the first step toward building a more profitable, stable, and secure future for your firm.